Well, Nobel laureate for economics and Columbia Business School professor Joseph Stiglitz addressed media in Cape Town this morning on the opportunities for growth in Africa. Thomas Maree spoke to him and started off by asking him how the institutional change is linked to furthering economic change.
It basically has to happen from within. It's basically a process of closing the gap in knowledge between the advanced industrial countries and the developing countries. It's a part of the process of learning, of ensuring that that gap in knowledge is reduced.
Talking about that gap of knowledge being reduced, how would African states approach, in terms of their economic policy, trying to close that gap and trying to bolster economic growth in their countries?
Well, I think mainly it's by education, but also through processes where you, for instance, have foreign direct investment, but you learn from that foreign direct investment. So like in China, they had joint ventures, and they were joint ventures because the domestic, they wanted to make sure that those inside the economy learned from those outside the economy. Malaysia did the same thing. When they had a foreign firm come in, they required the foreign firm to train the Malaysians so that they could take on the jobs and create their own businesses that would be as competitive as those with any other firm in the world.
And what would you say are some of the key obstacles to investment in Africa? What do foreigners see as these key obstacles?
Well, in the past, there were problems of macroeconomic instability, high inflation, large debts, and problems of governance. But to a large extent, that's changed. There are many countries throughout Africa that have brought their deficits down, that have brought inflation down. Governance is very good, or at least reasonably good. The disappointment has been that outside of natural resources, it's been very hard to attract the foreign direct investment. And I think it will begin to happen. One of the reasons that it's going to begin to happen is that there is going to be more investment in infrastructure. That's been one of the gaps. Another reason is there's been a lack of domestic demand. And the domestic market in Africa is also growing.
What are your perspectives on the IMF and World Bank's trade policies towards Africa?
Back in the 80s, there was a period called structural reform that led to deindustrialization, or at least contributed in a significant way to deindustrialization. Tariffs were taken away. They were forced to compete with firms from all over the world, even though these firms, and the firms in Africa, had a lot of competitive disadvantages at the time. Lack of finance, lack of infrastructure. So it wasn't a level playing field. So they pretended as if there were a level playing field when there wasn't. I think the attitude, certainly of the World Bank, has changed very dramatically in this respect. The World Bank in the last 4 years has been focusing a lot on what we call industrial policies. How can governments help the development of particular industries through access to capital, access to finance, learning, access to technology, integrating them into global supply chains. So there's really been a very change in perspective, saying there is a role for government to help promote the development, industrial development of the country.
Looking now at the euro crisis, how would you say this still threatens the health of the global economy? What are the key lessons that can be learned here for Africa going forward?
Well, Europe is already in a double dip. The euro crisis is by no means over. There is a risk of much more turmoil, and if that happens, global growth will almost surely slow down. The good news is that the major source of growth, major source of demand for Africa, for Latin America, is coming from the growth of Asia, particularly China. And probably they will be able to sustain that growth, maybe a slightly slower rate. So it is true, you know, that I'm actually optimistic that even if there's a storm in Europe, Africa will be able to manage it well, maybe with a slightly slower growth.